I literally have no idea how the prior advisor was able to manage or monitor. And if that's one client, then that means there's probably dozens of clients with the same mix. And it's not sustainable for them, it's not sustainable for us, and it's not sustainable for the clients. So we had to come up with a simple solution, and we got it achieved. So big success.
Hear how this breakaway firm used DPL's tools and technology to make the transition to independence. You're listening to Advisor Revelations.
Welcome to the Advisor Revelations podcast. I'm your host, Rossman Goodwin, Regional VP of Member Success at DPL Financial Partners. Today, we will discuss how advisors are positioning commission-free annuities to help increase equity exposures while introducing a more scalable business approach versus traditional annuity models. I would like to introduce our guest, who is a wealth advisor at Singe Advisory Group, Jack Singe. Jack, thanks for joining today.
Thanks for having me, Ross. Appreciate it.
Yeah. Well, before we get started, I want to remind our listeners to please subscribe to this podcast on your favorite streaming app for updates. If anything we talk about today interests you, be sure to connect with a DPL consultant on our website, dplfp.com. All right, Jack, so that our listeners have a better understanding of who you are and what type of firm you're with, I think they can probably deduct that you may have a very close connection to the firm with that last name, a bit of a giveaway there. But yeah, tell us about yourself, Singe Advisory Group, and how long you've partnered with DPL so far.
It's great SEO having a difficult name in the name of the business. But again, Jack Singe, I'm a wealth advisor with Singe Advisory Group. Our firm actually just celebrated a 25-year anniversary just a couple of months back. We have three distinct businesses. We have our wealth management division that I head up here out of Clearwater, Florida. That's traditional family wealth planning as well as business wealth planning. So that might be more corporate retirement, executive benefit planning, stuff like that. We have our asset management business, which is more third-party distribution of our investment strategies. And then our advisor network that I know we want to talk about today, which is where we partner with independent advisors around the country to kind of help them grow and build their own practice. I've been in the firm, or in the industry rather, since 2009. I kind of came right out of college at a great time and joined a corporate entity. Realized pretty early on I wanted to kind of do stuff my own way. So I'd left and joined the family business in 2015 and been working with clients ever since. We joined DPL kind of mid-COVID. I think it was like 2021, 2022. We were having discussions and we really went proactive with DPL at the beginning of 2023.
Awesome. Yeah, that's great. So y'all definitely have was not necessarily a unique approach. You're clearly holistic. You have different ways that you're providing value to clients, but also to advisors. So with your all's network, you have a lot of advisors you're looking to support, and having a scalable and repeatable approach certainly is really important. Versus how you all looked at annuities in the past, how has DPL changed that scalable possibility a bit with what's possible in the last few years?
Well, having an advisor network, we don't really have one size fits all for our advisors. We have groups that specialize in very complex estate planning. We have other people in the group that are very diligent, maybe on the portfolio management, the investment side of their business. And then others that just want to do, fee-for-service financial plans. So part of where we stand in is to help them build out the rest of their practice. What are their solutions and services? Can we help them bring into their practice to either grow revenue, maybe expand their client base? And there's a big hesitation. There's a large group of advisors that are in our practice and even industry friends that I know and still kind of coordinate with that they're hesitant to move into the space, mostly for the fact that the economics favor compensation over the outcome for the client.
Right.
And so where we looked for DPL was, we actually started with myself looking for a client case I ran into, but advisors had been asking for a long time to have an equal opportunity of outcome for how they're compensated, but their client as well. And so can we provide a better solution that's maybe more cost effective, that brings maybe some of the red tape from the advisor standpoint and kind of pushes that a little bit out of our wheelhouse. And so DPL came in as a perfect solution of, hey, we can now expand a suite of insurance products, whether it's life insurance, annuities, disability, and some other stuff you guys are working on, that we're trying to give our advisors access to that typically would shy away from maybe due to compensation or just red tape?
Yeah, and it's amazing what happens once you see the restructuring that's happened, that now there's a bit of a different approach. It's really about what's best for the client given their circumstances. And many times the answer may not be annuities and insurance, but now that the compensation can be aligned, it definitely completely puts that on its head a bit. And now you can really look at everything on the same side of the table. And you mentioned the red tape. One thing with the DPL model is that we're doing a lot of heavy lifting for you and trying to save a lot of time. What does it look like now when you're looking at an advisory annuity versus maybe the old traditional model? I think you talked about it being pretty convoluted, a lot of hoops to jump through. Talk about that a little bit.
So the original process, and before DPL, myself personally, I never sold an annuity, and it was mostly for the fact as we started to go through kind of the financial planning process for a prospect. We might go through and do the full review, and maybe we would identify, hey, an annuity fits in this scenario. We used to joke when I was in the corporate world that saying the term annuity is like almost like a bad word. People hear it and they immediately jump because of cost,
right?
And they think someone's out to get them just on, they hear annuity, they think commission, they run. And so as we're able to go through in the past, you'd submit kind of a case to whoever your insurance partner was. You get an email back with a half dozen PDFs with different solutions kind of ranked by advisor compensation. And most of the time that just shied us away, at least in, advisors trying to take a fiduciary approach to working with their clients. It's my job to keep the clients as long as I can. I don't want to churn and burn clients. I want to have a client and develop with them throughout their career as my career grows. And so that's really changed now with DPL. Now, as we have a client case that comes through, we can pass a lot of the requests over to DPL or even use the online platform and start to screen out what we're looking for based on the client case. Maybe it's income, maybe it's growth, whatever it might be. We can do a lot of price comparisons. So now before we go through and just take these PDFs that came in an email and just run that back to the client, we're now able to kind of shop it around ourselves and then leverage the expertise you guys have for maybe some of the ancillary nuances we're not familiar with, or maybe we need some clarification on before we go to present to a client. So it's almost like we've opened a window to an insurance department inside of the group, and any of the advisors that are leveraging DPL can now step in, evaluate existing policies, or maybe shop for solutions, which in the past that was kind of, there was some guard in front of that process. And here's what you can kind of work off of. Here's the menu for today. Yeah.
And I think that process that you're talking about, the fact that you do have a network and you have a lot of different people that are part, the whole family, the extended family there that you've built through the advisor base, being able to take that process and then, all right, we're going to repeat this for someone else. And you know what to expect, I think is super important. And, really shouldn't feel like you're reinventing the wheel every time that one of these situations come up, because it is leading with technology and it is going to be tech forward in terms of how it needs to be implemented. And that makes us happy because it wasn't really like that. Even just 10 years ago, it was still light years behind. So really excited to see how that's being able to grow and make it so that you can log in today, Jack, and you can see what your network's up to, right? You can go in and see if some of your colleagues are active or are not active to this point, and maybe point out, hey, this person is interested maybe in growing that fiduciary model or growing fee-only revenue. And that's been another key part of the growth as well.
Well, and it's nice to have in this area in particular, I've always said the insurance world was very stuck in 1985 with just process, procedure. It was just very, very dated. And so having a partner now that's constantly reinvesting in technology not only makes the discovery process easier, it makes the client onboarding process easier. It makes us tucking another advisor in and opening the pipeline for them easier as well. So it's nice to not only have, okay, now we have this solution that's going to remove, a lot of the burden of commission. You guys are doing a lot of the compliance work on the back end where we're focused more on kind of tailoring the product to meet the financial plan and then helping on the investment side. But that technology reinvestment into this industry that's kind of been missing for decades is making the process and the sales pipeline for us much faster.
Yeah, that's great to hear. And that's absolutely what we're trying to accomplish as we continue to grow, and be more updates to come, hopefully, that make it feel even more like a one-stop shop when you go to our website and utilize the DPL ePortal. I'd like to quickly just shift gears a little bit. We were talking a little over a month ago, and part of the reason why we wanted to have you on the podcast was to talk about some of the impacts that you've seen to your financial planning conversations. And I think this is really important because our listeners, they like to hear about what's new at DPL, but I think hearing from advisors and what's been impactful is one of the absolute best takeaways that we can ever have. So you have utilized our platform and looked at situations where we've introduced the idea of increasing guaranteed income in the plan, and maybe many times increasing lifetime income where it actually steps up every year linked to performance, which is really neat. But the takeaway I thought was really interesting is how you were able to increase your equity exposure elsewhere in the plan. I think some advisors have heard of that concept, but maybe haven't truly thought about what does that mean on a quarterly basis, perhaps when you're actually meeting with the client, having the conversation about risk and growth projection. Tell us about that experience and kind of that light bulb moment there.
Yeah, and this actually kind of started with an actual case of ours. We do a lot of fee-for-service financial planning work, more on the consulting side. And every once in a while, we'll have another advisor we're kind of working alongside of. Maybe they have the majority of the wealth management business or something like that. A client came to us with an annuity and just said, hey, I like the concept of this. It has a rising income option to it. What do you think? And so send it over to us. We kind of kicked it over to you guys just to take a look at. And oddly enough, you came back with the exact same product with no commission to it. And so it helped us just identify real quick before we went back to the client, here's kind of where the economics are going to work either against you in this scenario. But when we do a financial plan, we always try to back into getting the client to be as detailed as they possibly can on their expense picture. Most clients can tell me almost every dollar of their net worth, but if it gets into the expense side, they can't figure it out.
Sure.
And so we do a lot of work with them and exercises to back into, okay, what are your fixed costs? What's variable costs? What's the legacy goals and things like that? And so in this case, for the client, we were able to back into that if we simply took Social Security for him and his wife, and then we added in a rising income annuity option that you guys helped us find, we exactly met his annual expense need each and every year, even accounting for inflation year over year, as long as the policy will provide some sort of cost of living adjustment in the form of performance from the underlying subaccounts. We should be able to maintain, at least keep as close as we possibly can to his projected cost for his entire retirement plan. And what was helpful is we were able to show the client the withdrawal need on his investment portfolio was going to go from where we thought it was 6.5% to 7% down to about 1%. So the investment portfolio that we were originally going to want to make sure we didn't have any sort of sequence of return risk. We didn't want to have a big blow up year. We just had 2022, 2023 where the market was a little volatile.
Right.
A lot of clients take kind of that gut check and say, I don't really want to go through that again. And so how we positioned it for the client was use the annuity to kind of cover the distributions. And if our withdrawal rate is so low, we don't need to worry that much about diversification. I mean, clients are very interesting. They all want to have all the upside of the market with none of the risk of the market.
Of course, yeah.
Yeah, take all the good with none of the bad. But as we start to bring the annuity into the equation, we say, hey, look, if we take Social Security and the income rider, we basically have everything covered. Now the withdrawal rate on the rest of the pie is much, much lower. So we don't need to have this portfolio that's focused on downside protection. We can focus more on the upside. And so we're almost leveraging this as the bond allocation and saying, hey, we know we need this to spit off X amount of dollars every year. I don't need corporate bonds or I don't need municipal bonds doing the same thing. Let the annuity run all of the income we need and let's suck as much income out of it as we possibly can. And then let's focus on long-term appreciation with the rest of the portfolio. And it's almost becoming like a barbell approach. Any advisor knows they're going to run up against the S&P 500 benchmark for clients. So let their equity component chase it. Or if they want to outperform it, find another index that's close and tailor the portfolio that way. But carving out this piece that's purely almost like we're going to deplete as much capital out of this as we possibly can, it allows them to kind of separate out their focus for the different investments. And so that's been really beneficial. A lot of clients are gravitating towards that. Rates are higher than they were just a couple of years ago. So now they see kind of the return on the benefit of that income rider. But it's also allowed them to put a big wall up between what we're doing with the rest of the portfolio and now this income only source.
Yeah, it's great. Yeah, and it sounds counterintuitive, but the annuity is going to draw down to $0 balance. And you said just maybe a quicker time frame. It could be like 15 to 17 years. But ultimately, it's going to provide income through those mortality credits. So it's always coming in. And then the long term actually helps the portfolio maybe have a greater value, even though that asset was depleted so quickly. So that's where it's so key to have those conversations. What are you trying to protect against? How long are we expecting to live? And if it's into the late 80s, early 90s, late 90s, you can see that benefit pay off with the terminal value in the plan actually go up because the annuities solving that cash flow. And then you did the exact right thing. Let's take a look at the rest of your portfolio, maybe be more aggressive. And didn't you say that they also had some comments of, wait, we're actually projecting higher returns now? That's because we don't have to have a balanced approach. We're more of a pure growth oriented approach now.
Yeah, it's almost like you're trying to redesign. If we take their whole balance sheet and we chop it up by what the assets are doing, maybe there's property they're never going to sell. It's going to sit there. It's going to go to the kids. Okay, we can earmark that off to the side. The annuity fits into the bucket now to be kind of the workhorse on income. And that's just going to pay as much cash as we possibly can. If it burns to zero, the rider is going to continue to pay. The client understands that we're going to deplete capital in this bucket, but we're not going to deplete income in the bucket. And now the rest of the pie that's kind of more aspirational, long-term focus, we can start to invest it a little more long-term. And so we're kind of separating and decompartmentalizing all the different assets they own and allowing them to look at this and say, hey, it's not this scary high fee product like it was in 1990. I mean, technology is making these things more effective, and companies like DPL are making them more cost effective, and the incentives are in line with the advisor. If we're going to charge an advisory fee on the policy, we're going to get paid over time as it performs, not as it is sold, which I think makes the benefits more in line. And then the stock component can be focused more on the returns, because clients always want returns. They just need to realize that this bucket's going to be a little separate from their income bucket.
Yeah, and it is a shift, right? An approach in terms of, hey, I'm selling this product versus we're using this for a specific need in the portfolio. And on a year-to-year basis, you're still going to meet with the client and try to maximize that accumulation value. For one, you're charging an AUM fee off the account balance now for as long as it remains. But two, the better you perform, the more rising income you're going to get. So all of that is completely aligned now with the client, which is why this is continuing just to grow and expand as a need in the advisory world. So that's great. Jack, I definitely want to make sure we can shine on Cinj here. I think we have quite a bit of listeners who maybe are in need of a partner who can help them scale their business from an RA back office standpoint, have a customized partner to really help them reach the next level. What are the typical type of advisors or firms you have partnered with? What are some of the benefits you're bringing to RAs who need more of that roll-up approach that's out there?
So a lot of the advisors we work with, I mentioned it's not one size fits all. We have larger shops, a few $100 million with dozens of staff that focus on maybe complex estate planning. We have other groups that are very into holistic family planning. We have others that focus purely on business farmers. I think what we've been good about doing is we spent a lot of time investing into infrastructure for the firm to start to scale out all the resources an individual advisor might need to kind of launch themselves where they want to go. I see all too often, coming from kind of a corporate finance, not going through the employer itself, but in my past life, there were so many advisors that would sit there and they'd be too scared to make the jump because they were either A, worried about, I'm going to go from this nice, comfortable salaried position, and now I'm kind of working to kind of grow a business from scratch. And I think what we're trying to build is a platform that's easy enough for somebody to tuck in and start to see their runway to kind of be their own independent firm, their own practice. And so we've now structured that where we have all the technology somebody needs to start day one. We have all the agreements with all the custodians to get them up and running if they're on the investment side. We have partners like DPL that can help with the insurance side. And so we're trying to provide as many services that our existing firms are looking for that Another firm that's been with us for 10 years might not have even known they could incorporate that into their practice. So typically we're looking for, the either solo shop or the few advisor shop that's looking for their next scale. They're looking for help with marketing. They're looking for help with succession. We're trying to be that partner that they can tuck into easily. They don't have to change their branding. They can kind of run their own firm, their marketing, the way they want to run, but leverage us as that almost white labeled back office that helps them with these other areas they might need.
Yeah, that's awesome. I think there's a big demand for that. I think a lot of listeners will resonate with what you are providing. So that's great. And then you mentioned, afraid to make that leap or that next step. We have, of course, in the last 18 months or so, expanded our Breakaway Accelerator program. And we think moving forward, that might really align with how you all are looking to bring in a good, advisors who are a good fit for your model. So how do you anticipate that maybe playing a role as well?
Well, as we meet with prospective advisors, one of the things we talk about is, okay, if you're going to break away and you're going to, join a new firm, everyone's always worried about the same things. They're worried about repapering clients. They're worried about, technology. I have this CRM. Now I'm going to go over here. So there's all this adjustment that needs to come through. But a lot of times, depending on the firm, as we see firms, they might have clients that they don't even know who they are. And it seems odd, but it's an advisor joined them and then left and they don't have a relationship. And so what we've started to see is as advisors join us, the goal we try to emphasize is like, how do you want to design the practice for the next 10 years, the next 20 years? And as they make the jump, we need to figure out, okay, what do they need? Maybe they don't want to be tied into a broker dealer. Maybe they want to be purely an RIA. They want to focus on planning, kind of the fiduciary mindset. And that's fine. We can now still allow them to service that book of business. They don't have to just leave it behind. They can partner with DPL to allow DPL to be the agent of record for the policies, let them continue on the wealth side. I mean, even from my own experience, we've used the platform for legacy annuities, even clients coming on board that maybe we can't get out of the product yet for either the riders are fine, the policy's working well, or they're so deep in surrender, we can't do anything with it. You guys take over the policy. It feeds into our performance reporting system. It feeds into our plans. We can still operate like we're the advisor of record without being the advisor of record, which, comes with all the compliance requirements. Sometimes you have to go get appointed with a carrier that doesn't even know who you are. So sometimes it's more work than there's the return on investment. But now through the Breakaway Accelerator program, we just kind of tuck it into that avenue and continue moving the client relationship forward.
That's great. Yeah. And this year we did fully launch our Orion partnership, which has helped to make integration way easier. And for a firm like you all that have a network of advisors, and there's a lot of different people involved across organization at the home office and then individual advisors, that scalable integration into Orion is definitely a key to getting this done initially for a partnership, but then building and scaling it from there. So,
well, I also can't tell you how many times we've completed the paperwork to become the advisor of record just to be dropped by the carrier for not doing enough production.
Oh yeah.
So
sure.
That's, you're redoing that same process every 3 to 5 years. And this has become, hey, we're going to almost like incubate them over to the side. We're still going to monitor them. We're still going to help the client through making sure the product works. We're just unfortunately kind of stuck in that area. Mm-hmm. And so it's a great avenue, especially for advisors that don't want to focus on that legacy business anymore. You don't have to get rid of it.
Yeah.
It just needs to kind of get parked with the Breakaway Accelerator program.
Yeah, 100%. And then it's not, we're never going to review this again. As you'll see, we'll come back and say, hey, now it makes sense to maybe look at something new, or the rate environment is more favorable. Let's look at maybe repositioning this. So it's never just a forget about it. It's we'll talk about this later situation. So that's perfect. So Jack, it's also kind of funny how we got started, or maybe it wasn't funny at first, but you all had a client relationship where they had 16 different annuities. Isn't that right?
So I think it was closer to 31 in total, but we worked on 16. So
okay, that's right.
One of our longstanding clients asked us to help her mother through settling her father's estate. And so, of course, we figured we see this all the time. We'll just set up a meeting and go through with them. And they showed up at our Tampa office with literally about 3 feet of paperwork to do beneficiary claims for the husband.
Yeah.
And so it probably took us 5 hours to get through all the forms, make sure they were done, whatever needed to be notarized, get that done. And as soon as the meeting was done, I asked the mother, I said, I'm just curious, what does your portfolio look like? And she's like, I had the exact same thing. And so going through this whole process, the advisors that sold all the original annuities never followed up to help with the estate settlement. He kind of cut and run at that point. And so here we had, very longstanding client that now has her mom that wants to work with us. And the portfolio is comprised of 16 different annuities from, all different carriers under the sun. Products I've never heard of, carriers I've never heard of.
Yep.
So this is kind of how we reached out to DPL is we said, let's try to do this a different way. Typically, we'd contact every one of the carriers, go get appointed, try to become the advisor of record. A lot of times we get rejected because we weren't the selling agent for it. And we said, hey, this is a great client we have. This is our mom. Let's take care of her mom, just like any other client that works with us. And so we brought all this to DPL, and you guys did all the heavy lifting. You did a lot of the paperwork to get this organized to kind of...
Shout out Jeffrey.
Yep. Shout out to Jeff for all the work on that. And then what we tried to work on was over the subsequent years. So this client was our first client with DPL. And my kind of request to DPL was we need to consolidate this into something more effective. Client can't keep up with this. Her accountant can't keep up with this. We just went through her husband passing away and the kids had a whole nightmare dealing with this. So we need to work to simplicity. So I'm happy to say today, she's down to a single annuity and a single investment account. We didn't have any meaningful surrender charges to get out. Luckily, this happened probably 2022. And so we had a very favorable rate environment. So there was a lot of opportunities to get out of this legacy commissionable annuities with some of the worst participation rates I've seen,
right,
and convert that into stuff that did very, very well as we went into kind of the volatile market of 2022 and 2023. So it was a huge win for us. We kind of threw the kitchen sink at DPL for the very first onboarding we had. It wasn't like, hey, here's cash. What do we do with it? This was more of, hey, we have a lot of unique products that probably aren't sold, that are very old. Some of them have commission or surrenders rather that were 10, 12, 15%. And we slowly worked out of them over a couple of years. So it was a great outcome for the client. The client's a big advocate now for the firm, which was helpful. Her estate plan now to her kids is seamless. There's only 2 assets we had to deal with. Everything's wrapped up around her trust. So we took a very complex estate, made it very, very simple, which has been a delighter for the family. And ever since going through that, we now have the rest of the kids are coming on board as clients because they saw, hey, here's what mom and dad's advisor did. Now here's what one of the daughters, her advisor's been doing. And so it's kind of expanded our wallet share with the whole household pretty dramatically.
That's huge. And we love hearing those success stories because sometimes you just get focused on the one annuity contract or having a better solution versus where they are today. But there's a bigger impact not only to that client, but then maybe the entire family. And being able to win them as clients is awesome. And just goes into how you all took a holistic approach and try to lead with simplicity. We're obviously aligned on that. And ultimately, led to a better outcome. So,
you know how hard it would be to get 16 annuities to feed into our performance reporting system to track them?
Yeah,
like that alone would be too hard.
Right. So, no, that's great, and I'm glad we're able to deliver, on the front end there, and just make life easier for everyone involved. I'm sure you're happy too that it's not 16 annuities anymore.
Well, it's manageable. I literally have no idea how the prior advisor was able to manage or monitor. And if that's one client, then that means there's probably dozens of clients with the same mix. And it's not sustainable for them. It's not sustainable for us. And it's not sustainable for the client. So we had to come up with a simple solution and we got it achieved. So big success.
Awesome. Love to hear it. Well, no, Jack, I really appreciate you coming on the podcast. I think a lot of great insights that advisors can take away and you'll consider moving forward. And I think the insights into the portfolio conversation as a whole are super important. And sometimes, that thread isn't pull all the way through. It's just focus on the day-to-day income. But what does it mean to the rest of the portfolio? I think that is super impactful. And anything else you'd like to share about working with DPL or anything else we should expect moving forward with Cinch?
No, I think if I was going to leave it anywhere, I'm a huge advocate for efficiency. I've been pounding the table for a while that, a lot of these AI tools and stuff that are coming, they're going to make the advisor client experience that much more efficient, allow you to service your clients more efficient. And having partners like DPL that are starting to build out the efficiencies in this corner of our business is something we want to make sure we emphasize. It's been extremely helpful for us. So other advisors that are out there that have questions or want to ask questions, feel free to reach out. We're happy to give our 2 cents on the success we've had with DPL.
That's great. And you've been very proactive about sharing feedback, but also what you like to see as a next step. So I think we'll have some really good news before long about how this process with advisory annuities can become more of a kind of self-service option. And I know we're excited to see where this goes over the next months and next years as we continue to partner with you. So appreciate that you joined the podcast, Jack.
Thanks again. Thanks for having me. Appreciate it.
Absolutely. Well, we just want to wrap up here. Remember, everyone who's listening, you can connect with us at dplfp.com. Encourage you to subscribe wherever you get your podcasts, and appreciate you listening. Have a great one.
Thanks for listening. To hear more Advisor Revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.